In April 2024, the US stock market experienced a notable decline. This downturn was triggered by hotter than expected inflation data, which had a significant impact on investor sentiment. As we delve into the details, we'll explore how this unexpected inflation report reverberated through the financial landscape and influenced market behavior. Let's dive in. The CPI rose by 0.4%, surpassing economist expectations of 0.3%. On an annual basis, the CPI increased by 3.5%, which was higher than the anticipated 3.4%. The core CPI, which excludes volatile food and energy prices, also exceeded expectations, rising by 0.4% from February. The hotter than expected CPI readings have raised doubts about the central bank's ability to act soon in terms of rate cuts. During the March policy meeting, the Fed officials expressed their willingness to hold interest rates at their current level for longer if inflation remains stubborn. Ryan Dietrich, chief market strategist, said that the stickiness of inflation data caused a sell first, ask questions later mentality, and that disappointment caused a pushback on not only the potential timing of the first rate cut, but how many we're going to get. During the 20th of March 2024 meeting of the Federal Open Market Committee, officials expressed their concerns about stalled inflation progress. The FOMC closely monitors inflation trends as part of its mandate to promote maximum employment and price stability. Despite the recent surge in inflation, the committee remains cautious about the sustainability of this upward trajectory. Officials acknowledge that the consumer price index exceeded expectations, but they are wary of potential transitory factors driving the increase. The FOMC assessment of appropriate monetary policy is crucial. It considers various factors including inflation data, economic growth, and employment. The recent tumble in US stocks was closely tied to movements in benchmark treasury yields. The 10-year treasury yield surged to above 4.5% after the release of hotter than expected inflation data on Wednesday. This yield level was the highest since November last year. Rising yields indicate increased borrowing costs and can impact investor sentiment. Despite the surge in yields, equity markets continued to rise in Q1 2024, posting strong gains. The S&P 500 index intersected with its all-time intraday high, reaching 5,261 points, but faced minor resistance at this level. The market's focus shifted to future earnings expectations and AI-driven productivity gains, which contributed to multiple expansion. Large corporations with strong credit ratings benefited from falling net interest expenses due to rising rates. Smaller companies lacking credit ratings were more exposed to bank loans and faced quicker real borrowing costs. Profit sentiment remained stable for large caps but worsened for small caps. When inflation rises, certain sectors are more sensitive to interest rate changes. These include sectors such as energy, real estate, healthcare, utilities, and consumer staples. Historically, these sectors have outperformed on average during periods of elevated inflation. Investors tend to seek refuge in these areas due to their defensive nature. On the day of inflation report, the real estate sector experienced a significant one-day percentage drop. Real estate stocks are particularly sensitive to interest rates, as higher rates can impact mortgage affordability and property demand. Housing stocks, which are closely tied to the real estate market, also declined sharply. These stocks include companies involved in home building, construction, and related services. The broader small-cap index, the Russell 2000, also faced downward pressure. Smaller companies often have higher sensitivity to economic conditions and interest rate changes. Thomas Martin, senior portfolio manager of Global T, emphasized the significance of the CPI report regarding expectations for Federal Reserve rate cuts. The markets reacted as anticipated. When there was a meaningful surprise to the upside, which indeed occurred, investor sentiment shifted, he said. The CPI data prompted markets to reassess their expectations regarding the timing and extent of Fed rate cuts. Prior to the report, financial markets had priced in a 63.7% likelihood of a 25 basis point rate cut in June. However, after the CPI report, this probability dwindled to just 16.2% according to the CME's FedWatch tool. The reduced probability of a June rate cut suggests that investors are now less confident in the Fed's immediate easing measures. While a July rate cut remains possible, the expectation is that there there won't be more than 2 cuts in total this year. The market's breadth was negative, with more declining than advancing issues on both the NYSE and NASDAQ. This indicates a broader market sell-off rather than isolated with sector weaknesses. The S&P 500 and NASDAQ composite saw a spike in new 52-week lows, reflecting investors' concerns over the economic outlook and potential for continued inflationary pressures. The Investor Sentiment Survey for the week ending April 3, 2024 showed 47.3% bullish, 30.5% neutral, and 22.2% bearish. This suggests that while there is a significant bullish sentiment, there is also caution in the market. For Q1 2024, analysts had forecasted a modest earnings growth rate for the S&P 500. The estimated year-over-year earnings growth rate was 3.3%. This would mark the third consecutive quarter earnings growth for the index. The actual growth rate for Q1 2024 has outperformed the initial forecast from January 1st, 2024, which predicted a lower growth rate. This positive outcome reflects a resilient corporate sector despite economic headwinds. The technology sector in particular has been a significant contributor to earnings growth, with companies like Nvidia showing strong performance. Looking at the overall earnings picture on an annual basis, total 2024 S&P 500 earnings are expected to be plus 9.5% on plus 4.7% revenue growth. This is above the trailing 10-year average annual earnings growth rate. Despite concerns about a possible recession, the S&P 500 earnings resilience suggests that many companies have successfully navigated the challenges of inflationary pressures and interest rate hikes. In conclusion, the S&P 500 earnings outlook remains positive, with analysts expecting continued growth throughout 2024. This optimism is underpinned by strong performances across various sectors, particularly technology and the overall corporate sector's ability to adapt to changing economic conditions. This has been Wall Street Forecast. Thanks for watching, and I will see you on the next one.